All right, welcome back. We're going to do this again. Mid-quarter roundtable. So middle of the third quarter, 2024. And this time in our new podcast studio, we got our first guest from Invesco. I'd like to welcome and introduce Brian Levitt. Brian?
Yeah, happy to be here. Thank you.
Great. So let me tell you a little bit about Brian first. Here's his bio. Brian is a global market strategist at Invesco. In this role, he specializes in developing investment outlooks and analyzing timely market and economic themes to determine what may have an impact on investment strategies for both financial professionals and investors. Mr. Levitt helps financial professionals connect with their investor clients by providing clear context and communicating investment views using practical analogies and stories. He's the author of Invesco's compelling wealth management conversations program, which seeks to help investors manage emotions and stick to their investment plans, as well as the firm's financial literacy program, which is designed to educate families on personal finance. Mr. Levitt co-hosts Invesco's Greater Possibilities podcast and is the author of Invesco's Above the Noise monthly newsletter. He's often quoted in financial services media, including Barron's, Financial Times, The Wall Street Journal. He's a recurring guest on CNBC, Bloomberg, and Yahoo Finance, so you may have seen him before. And Mr. Levitt earned a BA degree in economics from the University of Michigan and an MBA with honors in finance and international business from Fordham University. And we're glad to have him.
Yeah, I'm happy to be here. Thank you.
Perfect. Well, let's talk a little bit about, market recap's always one of the first things we do. Just so, again, if people haven't been following it, kind of where we're at, currently, really since the last podcast. So about 3 months exactly, I think, to the date and year to date. So Kyle, you want to do that real quick?
Yeah, so kind of just looking across the markets here around the Dow, we're about 7.3% roughly since our last podcast, and really about 10% year to date. S&P about 6.5% since our last podcast, and 18% year to date. NASDAQ, the tech heavy, which has really been driving the markets for the year, from what we were seeing at the start, kind of did slow down a little bit since our last podcast, was only up 4%, and now brings it about 17-18% for the year. And our bonds, I think we can celebrate a little bit. We're finally seeing some positive returns in the bond market, up about 6% since kind of that mid-May range to now, and 3.5% for the year. And commodities, which kind of bailed us out a little bit the last couple of years with inflation, still positive 2% roughly for the year, but since that mid-May range, it's down about 6-7%. So pulling back a little bit here.
Yeah, so I thought what we'd do here is just kind of use Brian as a resource and talk through him, and then we'll see what we learn and join in from there. So I think the first thing, market performance, which we kind of went over, Brian. How would you characterize the markets so far this year?
It started off as a very heavily concentrated market, and I would argue that was because all the expectations for a broader market, a small cap rally, all happened in November and December. So if you're like me and you write outlooks for a living, by the time you got it out, the 20% rally in small caps had already happened. And a lot of that was because of the expectations for 6 rate cuts. Now, the market then had to back that out. So if you think of what a lot of the first half of the year was about, economy was pretty resilient and the market was backing out those 6 rate cuts. And that type of environment, the mega caps did well. It was really the market was saying small caps value. They may need some rate cuts to help them out a bit. And I would say more recently, the market's enthused that the Fed can lower rates here, and there's not going to be a recession. So this market lately is a soft landing trade more, meaning, again, Fed lowers rates, economy plows through, and broader participation is the result of it. And it's not as if the broad market or the tech names haven't kept up, but they've participated, but they haven't kept up as much as value and small caps and cyclicals have done as of late.